Good afternoon, ladies and gentlemen. Today is March 14th, 2018. This is Michael Camo from T3 Live, and I'm proud to welcome you to our latest webinar, How Jeff Cooper Turned Fear into a Pinpoint Trading System and a 30-Year Career. Can I get a quick sound check? Can everybody hear me? Thank you. Thank you, Bubble. Bubble is one of our biggest fans. Good to see you. So before we get started, please read the disclaimer on the screen. We all know that trading and investing is risky, but the rules require that you read this. So where is everybody from today? We got Seattle, Los Angeles, Colorado, Oklahoma, South Carolina, Windsor, Ontario, Columbus, Toronto, Argentina, Brazil, Virginia, New Jersey. We even got some New York people. Okay, this is a very special event. We actually haven't had a Jeff Cooper webinar in over 3 years. This is probably going to be our biggest webinar of the year. We have a ton of signups, and for good reason, because Jeff is a legend. Now, Jeff has been a highly successful trader since 1981. He started out trading for Drexel Burnham, which used to be one of the biggest investment banks in the world back in the 80s, and a hedge fund before going independent in 1986. And you guys may know Jeff because of his big series of hit and run trading books. And now I've known Jeff since 2011, and there's been three things that always stood out to me. And the first is that he might be the hardest working man on Wall Street. If you follow Jeff, you know that he's 100% dedicated to keeping people up to date. He's on the West Coast, and he's up at like 4 in the morning. He's running reports. He's blasting out alerts. He's issuing trade ideas. So he's going nonstop all day long. Second thing is just how loyal his readers are. We get tons of messages like, I've been with Jeff from the 90s, or hit and run got me started in trading. And then the final thing is just how often I see Jeff's hit and run trading books. Like if you know a serious trader, you go to their house, odds are you're going to see one of his books on the shelf. Now, before I hand the mic over to Jeff, I'm just going to introduce a few housekeeping items. The first thing is we are recording this. We will send it to you tomorrow morning. If you have questions, please put them in the question box now. We're going to hold the Q&A later, but we expect a ton of questions, so the sooner you get them in, the sooner you'll get them answered. And finally, we are going to make you a very special offer later on, so we hope you stick around. And with that, I will pass the mic over to Jeff.
Thanks, Mike. Good afternoon. I hope you all made some money today. It was a good two-sided tape. Several names on the long side and several names to short. My kind of a tape. So a bit of background is in order. In the late 1950s, my father could have been the poster child for the American dream. He was 42 years old, had sold his textile business for millions, and was retired, living the good life with his wife and 2 kids in Beverly Hills.
Jeff, sorry to interrupt. Can you share your screen so everybody can see? Perfect.
That work? Got it?
Perfect.
Okay.
Yep.
Anyway, so my dad was retired, living with his wife, 2 kids in Beverly Hills, California. And in order to keep himself busy, he invested in the stock market. After my father invested all his cash, the brokers introduced him to a new investment technique.
Jeff, sorry, you have a little box on your screen. Could you move it out of the way? And I think you're a couple slides behind.
Yeah, the control's not working on changing the slides, Mike.
Just click on it and click the right arrow.
There we go. Okay. So where were we? Anyway, after my dad invested all his cash, brokers introduced him to a new investment technique, margin. Jack, we can buy twice the amount of companies by using the stocks in your portfolio as margin. You'll make double the amount of money when stocks go up. Remember, stocks always go up if you hold them long enough. Well, this made sense to my dad, and he went along with the strategy. However, in May '62, my dad went bankrupt. On the day my mother was being operated on for cancer, The brokers who told my father that stocks always go up if you hold them long enough were mass liquidating his portfolio to meet margin calls. My family's net worth was not only wiped out, but we owed the brokerage houses money. This was my first experience with the buy and hold strategy that has once again become so popular with Wall Street. By the early 1980s, I had started and sold a small business, Dogtown Skates, and found myself gravitating toward Wall Street. After a stint at Drexel Burnham, I went off on my own and attempted to replicate my dad's success. And lo and behold, by 1987, I had become a big picture buy and hold investor as well. I was making great money until October 87, when the buy and hold strategy, the buy and hold curse, I should say, hit another member of the Cooper family. Fortunately, I did not go bankrupt, but I did get hurt, and I learned a bitter lesson, just as my father had 20 years earlier. So I set out on a quest to create a methodology to beat the stock market. So as you can see, I have a real fear of the markets. I saw my dad lose more money than he had to his name in just one day when I was 12 years old. My dad came back, taking 3 times out of the market that he lost and retiring. But he was gifted with an exceptional drive. He was a tough guy. My fear of the markets forced me to hone my timing and stock picking with precision. What I found is that in markets, it takes fear to induce respect. In my experience,
Jeff, sorry to jump in. Can you just make sure you're advancing the slides?
Yep. So what I found is that it takes fear to induce respect in the markets. In my experience, in this game, only the humble survive. I learned you don't play macho man with the market and to respect risk. You may think you're in charge, but without respect for the markets, you'll be in charge like General Custer. Markets can turn on a dime. Most traders cannot. My breakthrough came in the early 1990s after struggling after the 87 crash. I was fortunate enough to meet someone who had amassed a fortune short-term trading, but he had no rules he could explain to me. He told me how when he would trade at home, he'd watch the sparrows in his garden. When he'd feed them bread, they'd take just a little piece at a time and fly away. They kept on flying back and forth, taking small bits of bread. They may have had to make 100 stabs at one piece of bread to get what a pigeon gets at one time, but that's why a pigeon is a pigeon. You will never be able to shoot a sparrow. It's just too fast. That was the beginning of my quest to create a rules-based strategy, what I called the hit and run methodology. It's based on the idea that risk has to be measured not just by how much percentage loss you're willing to assume on a position, but by how much time you're exposed to risk, like the sparrows. It is designed around PE, not price earnings ratios, but pinpoint entries. If you can time your entry to coincide when a stock is going to pivot, it does a lot to instill emotional capital as well as financial capital. Getting into the business, most everything I read and most traders I talked to, except Sparrowman, said the key to success was trend following. They said the market is random and can't be timed, so you just have to follow the trend. But I was cynical based on my dad's experience and my experience in 87. In the 1990s, everything was buy and hold. In the last 8 years, the mantra has gone to the next level. Buy and hold became buy the dip. However, buy and hold, in my opinion, is just another way of saying follow the trend. But buy and holders don't have a way to determine when the trend bends, so they continue to buy and hold. If you're not in your 20s and are saving for retirement, this can be a disaster because history shows that sometimes it takes 25 years for the market to come back to old highs after a bear market hits. That's not been the experience this century when we've only had 2 to 3 year bear markets and the market came back to make new highs. That's just instilled and backstopped the whole buy and hold theme. So in 2017, we saw the longest stretch ever without as much as a 3% correction. Normally, you get a 5% correction every 3.5 months or so. Normally, you get a 10% correction once a year. Normally, a 15% correction happens about once every 2 years. Normally, a 20% or greater correction happens once every 3.5 years. The last 20% correction in the S&P was 7 years ago in 2011. I believe the markets are returning to its normal state. That is, a state of volatility. February was the wake-up call. This is a good thing for sparrows. If you have pinpoint entries and timing and adhere to the discipline of stops and have an uncle point for when you don't adhere to your stops, it's going to be your kind of market. It's going to be a trader's market. There's always uncertainty in the markets. That brings volatility, and volatility equals opportunity, and volatility is coming out of hibernation. It's fun to be a gambler, but I didn't like losing money early in my career. So I was forced to create a set of principles and a process, or ride a roller coaster and see my equity curve ride a roller coaster as well. It's all about principles and process. They go together. With a set of principles that treat speculation like a business rather than a fascination, every person can beat the market every year. That's what I'm here to tell you. Most don't believe it. You can only perform up to the level you believe you can perform, however. Fear is what holds every person back from realizing their true potential. Fear of failure, fear of regret, embarrassment, the unknown, you name it. Comfort comes at the expense of progress as a trader. Skepticism comes at the expense of opportunity, and fearfulness at the expense of living life to the fullest. The absence of fear happens with a process and a daily plan. That's what my morning report and nightly report seek to give you. Progress happens when we take control over the mental process. What do you need? The discipline of methods and rule-based strategies that are proven. Even those at the top of their game in every pursuit, be it sports, theater, you name it, they have a coach. For example, Paul Tudor Jones is a billionaire, and he still has Tony Robbins as his coach. The main principles of my methodology are: number one, trading is psychology. It is the art of capitalizing on mass emotions. The trader that doesn't have things thought out in advance will find that when pressure occurs, it will all be happening just too fast. This game is three-dimensional chess, not checkers. You have to be thinking about the next moves down the line your opponent may make, not just the way the chessboard looks right now. As legendary trader Bernard Baruch said, successful speculation is about anticipating the anticipators. There's a great little movie called The Suicide King starring Christopher Walken, one of my favorite actors. He plays a mafia don who gets kidnapped by some college students for ransom. Tied up, Christopher Walken says to them, "Gentlemen, the cards you are holding are merely dumb luck. Your success depends on your ability to read your opponent." That's the market. The second part of my principle, my process, is that I've learned that only the humble survive in the markets because they have a healthy respect for the game. They know markets can turn on a dime. Most traders cannot. I learned not to play macho man with the market, as I said before. You need to have a healthy ego to suit up and go into battle in the markets every day. But the trick of the trade is not letting your ego needs get in the way of your making money. To some, admitting they are wrong is more upsetting than losing money. They are looking for validation, and their need to be right is greater than their need to make money until they blow up. The market is a dangerous arena to look for validation. It has no idea if you are winning or losing. So I always like to pat myself on the back when I take a loss, because I adhere to my stop rather than say to myself, let me give it a little more room, let's see what's going to happen. It's human nature to do this, but we have to follow process and become like a winning machine. I also always pat myself on the back when I get back into a stock after being stopped out if the setup is revalidated. Because if you stop and think about it, That's the most bullish thing a stock can do, revalidate a setup. As I always like to say, the second mouse gets the cheese. Thirdly, part of my process, and the third principle that I think is the most important, is you've got to focus. The more you try to see in this game, often the less you see. You've got to narrow your field of vision and focus to be successful trading. There's just too many stocks, too much noise, too much to be overwhelmed by. You have to have a watch list so you can glean stocks' personality throughout the day and watch their behavior day over day. Relative strength, how a stock is acting in a down market like Twitter today and a deeply red market. They're saying something. Trying to see too much and do too much is just a function of greed. Fourth, sometimes the hardest thing to do as a trader is nothing, but patience pays. It pays to wait for the right pitch rather than swing at everything that moves. I know, I used to do that back in the 80s. Finally, you must have a quiver of strategies that maps various contingencies and patterns. My methodology has strategies to identify buying and selling climaxes and reversals, pullbacks, continuation setups, and trend days and breakouts over key levels. In short, my methodology is designed to be opportunistic. I found that often people will say to me, if your methods are so good, why teach them? Honestly, and I mean this seriously, writing my books and teaching my strategies every day is the most selfish endeavor I've ever undertaken. This is because doing so has forced me to continue to learn, and by putting my rules and analyzing setups every day, it forces me to stay on my feet and keeps my feet to the fire. It keeps me sharp. These are some of the strategies. 1, 2, 3 pullback is a continuation strategy and a strongly trending name. The Holy Grail buy setup is a pullback, another continuation, a pullback to the rising 20-day moving average, and an NR 7-day is the narrowest range, and 7-day is a volatility setup. Stocks breathe, they contract, and then they expand again. These are some of the continuation setups that we use every day. There's been an extraordinary absence of volatility in the last 7 years. Not coincidentally, since the Fed initiated its last round of monetary ease called QE3. This perpetuated a manufactured market, in my opinion, an abnormal market, a calm market, one where volatility was subdued. But now the Fed is on the march of QT, or quantitative tightening. Volatility is actually the normal state of the market. In February, we got a taste of the market reverting to its normal self. Opportunities on both sides of the market are going to increase along with volatility. Historically, low interest rates that pushed market participants to search for yield perpetuated the short volatility trade. That blew up in February. Low interest rates also backstopped corporate buybacks, with corporations borrowing at next to nothing to buy back their stock. This also underpinned the one-way volatility trade and the one-way ETF lazy river trade that we've seen for the last 7 to 8 years. However, many market luminaries such as Paul Tudor Jones, Ray Dalio, and the bond king Bill Gross believe a generational bull market in bonds has ended. Interest rates are going up. With it, opportunity and a reversion to this inherent, natural, and normal historic volatility in the markets is coming back. Even if you believe the economy is on a new growth trajectory, then excess corporate cash will go into capital expenditure, not buybacks. This will also increase short-term opportunities on both sides of the market as volatility increases. If you don't think the economy is going to remain strong and that a bear market may be on the table, then volatility is going to increase in a bear market also, offering greater opportunity on both sides of the market than we've seen in recent years. This is because some of the sharpest rallies actually occur within bear markets. My methodology is based on pattern analysis largely. If you want to make money, trade patterns and price. The quickest way to lose money is to listen to opinions. As I always say, speculation is observation, pure and experiential. Thinking isn't really necessary and often just gets in the way. My methodology allows you to avoid the disastrous situations associated with buy and hold, and will give you a set of tools to use to profit from the stock market for the rest of your life. So let me hand it back over to you, Mike.
Okay, thank you very much, Jeff. So we hope everybody enjoyed Jeff's presentation. We are going to get to the Q&A very soon, but we want to talk to you about a very unique opportunity to get Jeff's trades and to learn how he trades. Now, Jeff just updated his hit and run trading strategy for 2018 and beyond. If you follow Jeff on Twitter or anywhere else, you know he's an idea machine. He puts out 20 plus trades per week, dozens of reports, updates, analysis, everything. And he has a knack for picking stocks that you'll never read about in the Wall Street Journal. And so the first part of this is the Daily Market Report newsletter. Now, this is Jeff's flagship. This is his morning report with his macro outlook, which is basically his big picture view of the S&P, gold, tech stocks, things like that. Then there's the nightly stock report, which is a whole second report that's sent after the close that gives you actionable ideas for the next day. And plus there's intraday alerts for even more opportunities and more analysis. Now, conservatively, we say here 20 plus trades per week. It's probably more like 30 or 40. That's a $95 per month value. Now, just so you know what it looks like, again, morning report, this is the deep dive. So you're getting a top expert's view on the market, SPX, NASDAQ, Russell 2000, gold, sort of like the big picture of where the market's going. Intraday alerts, when there's a new opportunity, there's an update to a trade, you get an instant email. A nightly stock report will give you 3 to 6 trade ideas for tomorrow morning, plus updates on swing trades, and also Jeff's personal watch lists. We just got a comment from our favorite customer, Bubble. Morning newsletter is sheer genius. Then I just said the hit and run strategy has just been updated. And so we just recorded an all new video course with Jeff. It's over 2 hours long. It's the hit and run methodology updated for today's market. It has 20 actionable trading setups. So it's 10 buy setups, 10 sell setups. So you can get reversals, extensions, momentum, and all types of markets. Now that's worth $195. And so what these strategies help you do now, just for example, the strategies for piggybacking institutions when they push momentum stocks up. You can jump on shorting when big mutual funds clear the decks. You can get long hot momentum stocks when they take a break, plus 17 other strategies. Now, everything is taught with clear, simple instructions. You don't need to be a rocket scientist to understand any of them. Everything is like super simple, super clear, and everything is a formula. Like there's no guesswork. It's a stock needs to move, for example, a stock might need to move a certain amount in a certain number of days, and Jeff spells everything out in a crystal clear manner. Now, the deal is, now normally the Daily Market Report newsletter, $95 a month. The course is $195, so that's a total value of $290. I'm going to blast you guys a link. You can get both for just $47.50. Okay, Elaine just asked where is the link. I just sent it to you guys. Does everybody see the link? Everybody got it? So now the reason, um, if you just subscribed, you should get the course. Now, the reason this $47.50 deal is so good is because you can buy Jeff's book for 75 bucks on Amazon. So obviously you're getting not only the whole course, but the newsletter. Also, Jeff's other video course, his older one, the new swing chart method, is $495. We're getting some questions. We will answer them all. Somebody asked about like WD GAN analysis. That's part of the newsletter, so you will get that as part of the newsletter. Now, okay, now these are some comments from Jeff subscribers. And for example, we have using Jeff's technical analysis method. I recently purchased puts on Mike for $250, sold at $4,500. Most of my trades make money. One trade a week pays for the monthly trading fee. It can pay for itself weekly. I bought NVIDIA puts that paid off very well. Timing of entry was perfect. Management of trading was very accurate. Now it's $47.50 per month. So it's $47.50 for the first month. Then after that, it will be $90 per month. But if you're not crazy about it, you can cancel at any time. It's no problem. Some more comments. Greatest value, intraday alerts for buys and sells. These are typically my best trades and where I make most of my profits. Another one, Tom J. I have followed Jeff for 20 years. Enough said. It's another one. Jeff has kept me on the right side of the markets. Another one. You have a good feel for the direction of the market. Your method is different. I like the fact that it's so accurate. Another one. We're going to email the link out to everybody. For some reason, people are not getting the link within GoToWebinar, so we are going to email it out right now. Another one. I've subscribed to Jeff's services for many years, perhaps going back as 10, 15, maybe even 20 years. When I get an email from Jeff, I need to pay attention to my positions and the markets. The key here is that the timing is usually right. Even more, since I've subscribed to Jeff, I've made more money in the last year than I have in the last 5 years on my own. My personal favorite, I have made some real moolah over the last 2 weeks in PH, RHT, EOG, LFUS, RGR. Like the accuracy of these calls, with small positions, the subscription has already been paid off. Yeah, we're going to send the link out one more time in the question mark. In the question box. We're also going to email it out to you. We are going to bring Jeff on for the Q&A in just a minute. We're getting questions about the webinar. As I told you before, the webinar will be emailed out. We are going to send you a recording. Jeff Cooper, are you there?
I am.
Okay, we are going to start the Q&A. And so, as I said before, we have a lot of questions, so I'm going to consolidate them because a lot of people are asking similar things. We're never going to get to them all. So I'm going to consolidate the questions. So Jeff, we're getting a lot of questions about indicators like Fibonacci's and MACD and all that type of stuff. So does the hit and run system use indicators?
In a word, no. Since all indicators are really derived from price and or volume, I figure why not go right to the horse's mouth? Price is the final arbiter. In my experience, indicators are much more descriptive than they are predictive. Time and price and pattern are predictive. As legendary trader W.D. Gann said, time turns trend.
Okay. So do people need to throw out like everything else they've learned? People have learned like other systems. So a lot of people are wondering like, do I need to start all over again?
First of all, it depends upon what you've learned. Secondly, we can't really unlearn until we find something new. What I do recommend is while you're learning it, don't do anything else until you've learned it and wait until it becomes second nature. Then you can determine what in my approach fits your style and allow your inner voice and intuition to work. I find this is very important in the market. It's a big part of trading, but it requires a skeleton first, a skeleton of a method to wrap your strategies around, to wrap your intuition around.
Okay. So what I mean, we talked before about how you don't always trade like the most popular stocks. So could you talk a little about like the type of stocks you're trading?
Well, to make money as a short-term trader, whether it be a day trading or in a swing trade, you need to be where the action is. So, and typically, um, thin wins. So I'm very interested in the smaller cap stocks, uh, usually than the bigger cap stocks like Microsoft or Intel or um, or Apple.
Okay. So what time frames are your trades on?
Well, the I do a lot of intraday trading. The nightly report. Every nightly report has day trade recommendations as well as swing recommendations. The swing trades are typically anywhere from 2 to 5 days long, and often there will be what I call a big picture swing idea, which can last for weeks. Um, and also, almost every report, depending on the market tone, has both long and short picks every night.
Okay. So do you need a big account to trade these strategies?
No, I started with 20,000 in the 1980s after leaving Drexel Burnham, and I've never had another job since, other than trading since that time.
Okay. So I guess like I mean that brings up another important question. So basically, what's kept you in the game this long? I mean, I've dealt with a lot of traders. I very rarely deal with anybody that's that's been going for that long, at least in an active trading capacity. So like, what's kept you in the game?
Um, well, I feel my success comes from a real love of the markets. I'm not a casual trader. I feel it's my life. I have a passion for trading. It's not just a hobby. It's not even just a career choice for me. There's no question that I feel that this is what I'm supposed to do with my life. And you do the same thing every day, but every day is different. So it's a puzzle. I like the stimulation of trying to figure it out.
Okay, can you use these strategies for options?
Absolutely. I hear from, I mean, I'm not a big options player myself. Occasionally, I do recommend options, be it on the SPY or SMH, the semiconductor ETF, or GLD, the gold ETF. But I know from many subscribers that I've heard from that they often do play my recommendations with options. So yes, these strategies do lend themselves to the swing trades to play with options.
Okay, so I guess what about the mix of longs and shorts? About like where would you say the balance is? I guess what percentage is long and what percentage is short of your trade ideas?
I want to say it's probably 65 long, 35% short off the top of my head.
Okay, how about like what are your favorite ETFs to trade?
Again, like I said, typically the SPY, of course, the semiconductor, SMH, and GLD. Those three.
Okay, now the technicals that you teach in hit and run, do those work with Forex?
Um, I'm not a Forex trader. I don't trade currencies, but I do look at the dollar, and I do update with charts. Every report, every morning report has a couple of charts in them, and I do key off the dollar when it comes to uh, trading the precious metals miners.
Okay, so is the hit and run system, like, how hard is it to learn?
Um, I don't think it's hard at all. If you can take a 3x5 index card and move it across your screen, the price action on your screen, guessing what will play out next, you can learn my methodology. This is what I used to do, and this is part and parcel of um, how I created the methodology. Doing this exercise will show you how often you really can be wrong. I knew I was shocked at how often I would be wrong when guessing what the next move would be. And it just taught me how important it was to have a rules-based system.
Okay, can people use any kind of charting platform or any kind of brokerage firm? A lot of people are asking, like, can I use this with E-Trade, Ameritrade? Like,
Absolutely.
does it matter?
No, it
Okay,
doesn't.
all right, so what's your typical risk to reward for an intraday trade?
I'm not really using a percentage uh, for my risk to reward when I'm doing intraday trading. I'm looking at prior pivots, short-term resistance and highs. I'm looking at opening range breaks, the break of the first 30 minutes range of the stock, either to the upside or the downside. And if the stock is going back up to that range, I'll stop myself out. So it's really a matter more of intraday pivot points than a percentage, um, than determining a percentage loss. Uh, and at the same time on swing trades, I'm giving myself, I think in terms of how many points I'm making or how many points I'm losing. Obviously, it's going to be different if I'm trading a $30 to $40 stock as opposed to a $90 to $100 stock.
Okay, yeah, a lot of people are asking about stops. So, um, so I guess could you talk about, I guess, your philosophy, like, towards stops? Or are you putting stops on every trade?
I use mental stocks, but that's because I'm in my turret. I'm watching the screen all day long, and I've been doing it long enough that I've made enough mistakes to know that I have to honor my stop, and beyond that, as I said earlier, to have an uncle point when I foul up and I don't honor my own stop, a fail safe.
Okay, do you do any intraday trading of the, I guess, the index ETFs?
Only the only intraday trading of an ETF I do is on the SPY.
Okay, so it's just so it's clear for everybody, because we got a few questions like this. Jeff is mostly individual stocks. Could you actually go through some, I guess, Jeff, some of the symbols you trade most frequently?
That I trade most frequently? Well, I've got a watch list. Every week I create a watch list based on strongly trending stocks, both to the top side and the downside. And I'm looking for new 52-week highs. Um, with some of the stocks now that are on our watch list are Square, PAYC, um, Twitter, which behaved great today. I mentioned earlier, EPAM, E-Systems, EPAM Systems, SRPT, um, uh, and Nectar Therapeutics. Those are a couple of the names that we've been trading. What I like to do is to, in addition to my watch list, I have a core list of maybe 10 stocks that are really hone in on to try to get a flavor, because these stocks are typically traded by the same traders and they adopt a similar personality. So you get an idea whether they're going to run up in the morning and get hit, or whether they're going to make an opening, whether they're going to gap down and make an opening low. They tend to repeat the same behavior day in and day out. And when they don't, then they're talking. Something else is probably going on.
Okay, so a lot of people are asking about the offer itself. So $47.50, that gives you the first month, and then it will renew at $95 after that. So it's 50% off the first month. So the reason we do that is just so you can try it out at low risk, and if you don't like it, just cancel. There's no hassles of any kind. We'll just ask you why you didn't like it and cancel you. So it's just $47.50. There's no commitment. If you don't want it, you don't have to cancel. No big deal. Elaine just commented she purchased it. Thank you very much. So I guess so. Some people are asking, so how many alerts do you think you send a day, Jeff?
On average, I'd say probably 4 to 6.
Okay, and that's on top of that. There's also the morning report and the nightly stock report.
Exactly. So in other words, although there's swing ideas in the nightly report, things change during the day, and I may see a setup that is shaping up, and I'll send that an alert to either short it or go long at the market. When it's an intraday setup, I'm not using limit orders. I don't want to be the old saying I like is why be a shtick for a tick. So, and it'll take 4 to 5 minutes maybe for the alert to get out to subscribers. So typically all these intraday entries are at the market.
Okay, so so just to be clear, why are you doing limit orders during the day? Why market orders? Because I feel like we read a lot, never use market orders.
Well, as I said, first of all, it takes a few minutes for the alert to get out to subscribers, and I'm almost always initiating a trade at the market and exiting at the market. It's called a stock market, not a stock limit.
Okay, let's see what other questions we have. So people are asking, what kind of trades did you do today?
What kind of trades did I do today? Was that the question, Mike? Did you say what did I do today? Hello?
Yes,
Okay.
yes.
Sorry, couldn't hear you. I bought Twitter on an opening range breakout. We'd actually been, the report has been long Twitter on a swing trade. And I thought I had a great exit on it yesterday, or the day before, and it sold off yesterday, and came back with a vengeance today, and with the market down. So that showed me something when I saw it trigger an opening range breakout, which I mentioned before. An orb is trade over the first 30 minutes range. What I do is I bracket the first 30 minutes of trade. I use 10-minute bars in the intraday basis. So when it takes out to the top side, the top of the third 10-minute bar, or to the downside, that will trigger a down orb on trade below the bottom of the third 10-minute bar. I'll either go short or go long based on the daily position of the stock, obviously. So Twitter I bought today. We were in JD as a short from the report. And a lot of times when a stock is in a weak position, what I like to do is if it pops up in the morning, I like to reload and add to my short, actually. So I reshorted, well, I was short, but I added to my short position on JD. What I like to say is, as a rule of thumb, I like to short weak stocks as they try to stand on their tiptoes, and buy strong stocks as they get into a crouch. What else did I do here today? We shorted CRUS. I shorted CRUS into the close. Play, PLAY, which is Dave and Buster's. We got stopped out yesterday, and a lot of times you'll find that had a nice day yesterday, but didn't do anything to change the downtrend. And it's only a $40 stock. When it rallied a point yesterday and couldn't follow through, when that triggered an opening range breakdown, on trade below the first half hour's range. I got back in. I didn't send out an alert for subscribers to do it because I really wasn't sure. I just used my gut, and I didn't want anybody to get mangled in it after just getting stopped out. So let's just see. MZOR, I shorted today. That was a short setup from last night. It left train tracks, which is a bearish setup, especially after a strong multi-day run. So train tracks are basically a large range bar to the upside, followed immediately by a move in the opposite direction to the downside, just like it sounds, train tracks. And so MZOR opened basically flat, even up a little, and traded down 2.5 points.
Okay, so does the hit and run course, does this have all of your patterns?
Pretty much so. Pretty much so. There's a few proprietary patterns, and I'm always, sharpening my pencil and refining ideas, but pretty much all the patterns.
Okay. So, what do you do regarding, like, how do you advise people on trade size?
Say again?
What do you do about trade sizing? Like how do you I guess how do you advise customers when it comes to like trade sizes?
Depending on the size of your account, I'm looking to make X amount of money. I treat this like a business. I want to, like in a market, I want to buy and sell my vegetables and fruits before they spoil. So I'm just trying to turn over stocks, and like, the story of the sparrow, take little bites. Um, if I see the whites of their eyes on the trade, on a swing trade, I should say, um, I'm willing to give it more leash and lock it in if I think there's something, juicy in play. But as far as sizing the amount of shares, typically I'll start off with 1,000 shares, short or long, and if the stock validates my thinking and goes in my direction, what I want to do is press as it's going in my favor, and exit as the stock's proving me wrong. So
Okay,
I'm averaging up rather than averaging down.
okay. We're getting a lot of questions on about your books. So how does the video course compare to what's in the book in your books?
Well, what's changed about today's market is when I wrote the book, there wasn't decimalization. Stocks traded in eighths. So it was easy to read the tape. It was much easier. When something got on the move, when something got on the prowl, a Microsoft, for example, would rally, 78 and a quarter. And by the time you got in, uh, you can get a half to 3/4 of a point in scalp. Scalping was much easier. Now there are lots of dark pools and hidden pools. There's lots of hide the salami in games on level 2, which I follow. So it's a different type of game. The analogy I use is before there was decimalization, which I think was only created to enable the ETFs really and the volatility trade. That's another story. But the analogy I like to use is before with tape reading. And my dad was a great tape reader, so he taught me how to do that. But basically, it's like watching the wings of an eagle. So you could see those. When decimalization started, it was like trying to read the wings of a hummingbird. It's impossible. You and I can't do it. So that's one of the big changes in the market. But what's remarkable is that be it price or time, these patterns continue to play out despite program trading and what I call the algomatics dominating the market. So that's the good news for traders and for my method. But basically, uh, the difference in the new course and the 2.0 hit and run trading is there are a few new strategies and I'm tweaking them a little. The entry in the old book always used to be on trade through entry. By trade through entry, I mean if it was a long setup in a stock and Tuesday's high was 79.25, trade through entry in the old days in the old book would have been an eighth of a point or 15 cents above the prior day's high, so 79 30 35. Today, uh, virtually every trade that we're using in the setups at night, including trade through entry on trade through a prior day's high or low in the case of a short, will also be on an opening range breakout. So in other words, if you've got a stock in a downtrend, and today the market opened up and then reversed, a lot of these stocks pop up in the morning and then they'll take out the opening range low. So this is what I call a catapult orb. It's even better than a stock just opening flat or down and taking out the orb because it's pulled the rubber band first. So these are some of the new techniques and new strategies that I found I needed to refine as the algomatics and decimalization started dominating.
Okay, we're getting a lot of questions on like algorithmic trading and HFTs. Now, is that making it harder to make money as an active trader?
Well, I think I just answered that. What I really find remarkable, I happen to believe there's an underlying innate order in the markets. You asked me before about Fibonacci and Elliott wave, and I'll address that in a second. But what I really find is remarkable that although seems to be a lot more noise at the end of the day, ultimately, and I don't mean ultimately as in weeks and months, but ultimately as in within days, that noise plays out where this order, these patterns, these 50% retracements that I use, these midpoints of ranges, the market adheres to them despite the algorithms and despite the algomatics and the program trading and the ETFs. So that's real good news for people that are pattern trading.
Okay, and you like before you talked about volatility coming back. Um, like, do you think that's opening up more opportunities?
Absolutely. I mean, there's more uncertainty in the market since the February, shockwave, and uncertainty is just going to create two-way volatility versus the one-way volatility that we've seen that was backstopped by, this what I call this lazy river ETF short volatility trade, and if a bear market shows up, there'll be more opportunities on both sides of the markets as well. So this is really going to be a trader's market, and this is what I honed my my career on, and is the backbone of the hit and run. And just I said I'd get into this Fibonacci and Elliott because I know there are a lot of people that want to know about that. I'm not an Elliottician, but I do understand the basics. What I think is that if you put basically, I respect Elliotticians, I respect the theory. What I think is if you put 10 Elliotticians in a room, you'll get 11 different answers, sort of like economists. But there's a distinction between Fibonacci and Elliott waves. While Fibonacci is a part of Elliott, Fibonacci is math-based. There's no interpretation involved. There's just so much interpretation with Elliott waves. I am a big follower of W.D. Gann's method. Many years ago, I was fortunate enough to have mentored under the foremost Gann expert in the world, a guy named Jerry Baumering, who has since passed away. But he was a former physicist at USC, and he was brilliant. And he really gave me a lot of understanding of, what the quote unquote more esoteric side of the market.
Okay, so if the Fed can print money and buy stocks anytime it wants, doesn't that throw off day traders? I think you should first, because we're getting a lot of similar questions. Now, I think, can you answer that? Do you think the Fed is directly intervening in stock markets? And I guess if so, what's the effect?
Well, it's known that a lot of the central banks, the Japanese central bank, the Swiss central bank, has been a huge owner Whether they are at the moment, it's anybody's guess, but they were a huge owner of Facebook, and I suspect that the Federal Reserve has been an owner of stocks, U.S. stocks. And sure, the plunge protection team is a real thing. But with the Fed wanting to normalize their balance sheet and on a regime of a quantitative tightening, then my thesis is that volatility is going to come back to its more normal state. I don't think the Fed is going to step in, and the plunge protection team is going to step in at these levels. If they're going to step in, it's probably going to be from much lower levels. And if the market should have a get upside down and have a big a debacle like it did in '08, and the Fed should step in and do another round. Janet Yellen has said she'll, the Fed could quickly pull its experimental tools, the QE tools, out of the toolbox again at any time. If they do that and the market doesn't react favorably, that's going to send a message too, and volatility is going to expand again. Next. Mike?
Oh,
Okay.
sorry, Jeff.
No.
So, do you trade the FANG stocks? And for those who aren't familiar, FANG is Facebook, Amazon, Netflix, and Google.
Occasionally, not as much, because they've just been a one-way street. I do trade NVIDIA often. Amazon is just it'll suck up too much day trading capital. Ditto Netflix. And I do trade Apple occasionally, and I do trade Tesla. Not that it's a FANG stock, but it's it's one of those cold stocks like the others.
Okay. So, how much volume do you need to consider trading a stock?
Well, if it's a day trade, you want to see, if you're day trading the stock, you typically want to see, at least a couple 100,000 shares average volume. If you're swing trading and you like a stock, and it's thin, you don't have to be that sensitive to the daily average volume. But generally, I don't trade anything that's under a couple 100,000 shares.
Okay, so here's an interesting question. This is coming from somebody who said they're struggling with trading, and like, how do they know this is going to work? Basically, like if they've been struggling with trading, having a hard time making money, like how are you going to help?
There's two responses I have. First, I struggled. Everybody struggles in this game. It's like, if you're a surgeon, you don't go right out of the you don't go right into the operating room. You're at medicine school. You're at college and university for 8 years. So there is a baptism by fire. It took me a while to put a methodology together that suited my style, and it's worked for me. But there's a lot of psychology in the game. As I said, you have to be willing to pat yourself on the back, and it's not about taking a loss or taking a gain. It's by following the process on a consistent basis. That's the key. It's worked. It's worked for me, and it's proven. Um, that that would be my answer. You need you need to get in the game and trade small, and see if it suits your style. Um, I take my size down and trade small if I have a series of losses too, to get back into sync and back into rhythm. So to me, we all go through cycles. The market goes through cycles, and we go through our personal cycles. That's how I see it.
Okay, so on a kind of related note, like about how much experience do you think people need to really to get this to work?
Well, part of the beauty of it is of my methodology is the KISS principle. It's very simple to learn, very simple to follow. Um, and so, as I said before, the best people in their own, whether it be sports or theater, they have a coach. I still have coaches today. People that I talk to, I call them coaches that are fellow traders who have been around for a long time. So I, I think that's a big benefit to having somebody that has 30 years under their belt, um, who has been through, you know, many cycles up and down. Um, Four eyes are better than two.
Okay,
Everybody needs a coach at times.
all right. So thinking this is another interesting question. Like, why now? Like why is now the time to follow Jeff Cooper and to learn this method?
Well, now is particularly the time with volatility going back to the norm. It's just going to create more opportunity. It really is, in my view, just starting to become a trader's market again. I mean, if you look at what's happened since, I mean, only not even 2 months ago, since the S&P topped in late January, and you look at the number of opportunities on both sides of the market, up and down. Um, I'm not just talking about the S&P, but in individual stocks. It's it's really they're big opportunities.
Yeah, and on that note, folks, I just want to like reiterate, um, you're not going to find a better deal than this. It's just 47.50. You're getting 30 days of the daily market report. That's worth $95. You're getting the Hit and Run 2.0 course. That's $195. So that's a month of trading ideas. You would probably, I would say, end up getting about 150 ideas over the course of the next 30 days. Plus, you can learn his method, so you can come up with ideas on your own. So just click the link we sent you. I put it in the chat box. I'll blast it out one more time. We still have quite a few questions coming in. Um, or a lot of people are asking, like, what do they get tomorrow if they sign up now? You'll get the nightly stock report tonight, and then tomorrow morning, and you'll also have let me start again. You'll get instant access to the course, so you can watch it tonight. If you sign up today, you can watch it tonight and be ready to trade tomorrow. You'll get the nightly stock report tonight. Tomorrow morning, you'll get Jeff's morning report, and then you'll get intraday alerts throughout the day. Like whenever Jeff sees an opportunity, you're gonna get an alert. So I guess Jeff, so like what makes you send out an intraday alert? Like what are your I guess requirements to send out a trade?
I would say to send out an intraday alert, basically a stock triggering below certain levels of stock that I'm watching, triggering below certain levels. That, and probably the best tell, in my opinion, of a stock is its intraday relative strength, or day over day relative strength. In other words, like Twitter today, a stock that's um, going against the current in a down market, a green bean in a sea of red, so to speak, and vice versa. Um, That'll prompt me to send out an intraday alert.
Okay, so what do you think is the biggest challenge in the market right now? Like what do you think people are really struggling with, and how can you help?
Well, the new regime is a volatility regime, and people aren't used to it. People are used to buying the dip. Every dip has come back, and the market is giving that impression, or at least has given that impression off the February 9th low. At that time, after we bounced off the February 9th low, um, the mantra was all over TV, and most pundits were saying, well, after we create a W bottom, a test of the lows, then we're going to be back to the races again. And what we said in our report is that This is a market that didn't let you in 2017. It wouldn't come back. It didn't let you out after the January top. It just came right, went right into the abyss. And I saw no reason for it to change its complexion. And shortly after the low said, we thought it could make new highs. Now the Dow and the S&P didn't make new highs, but the tech area and the Nas and the NDX did, and the S&P and the Dow certainly rallied back up rather than rather than before they tested and put in this so-called W bottom. Now whether they go down and they make a W bottom now remains to be seen, but my gut is that if they get anywhere near the lows, that they're going to go through them.
Okay, now, so we're getting a lot of questions about like what you're actually writing. So, like, what would you say is the mix between like market commentary and like outright stock picks?
Well, the morning commentary, which I typically get up at 3:30 in the morning to write, is my macro outlook. Um, I'll focus in usually on the benchmark, the S&P. Sometimes I'll focus in on the gold miners, and there'll be a couple of charts, and they'll give my picture, the big picture outlook. They'll look at cycles, they'll look at retracements, um, and they'll give my feel for what to expect for the next trading day. After the close, I make my stock picks for the next day, both day trades and swing picks. So that's the mix. Um,
Yeah, so just so everybody's clear, like you're getting both. It's not like a wishy-washy. I mean, there's a lot of people that just put out very like generalized commentary without a lot of specific ideas, but Jeff gives both. Jeff gives like really hard-hitting, effective commentary and actionable trade ideas. So he's always putting his money where his mouth is. So now here's a pretty interesting direct challenge to you. If I'm new, how long will this take to pay for itself? So if people invest $47.50 today, how long is it going to take for them to make that back?
the next day.
All right, perfect answer. So here's an interesting question. Another one. So what are you personally struggling with most right now?
That's a very good question. I think I always, because I'm basically a cynic of the market based on my experience and my dad's experience, that remains part of my DNA. It's hard to shake that off. And I tend to get a little nervous in the service and don't let winners run um, as much as I should. But I've done a much better job on that in the last, I would say, in the last year than prior to that. But sometimes it's a double-edged sword. Sometimes that works to my benefit. As I said, we were long this EPAM, and I think we had my methodology on swing trades is as the stock runs up, uh, I'll figure out where I want to take a target based on different proprietary methods, and we'll take half off, and then we'll what I call trim and trail. We'll trim half the stock, and then we'll put a protective stop in at break even. As the stock moves up higher, we'll raise a trailing stop. So um, sometimes the stock will run up so much that I'll just want to take the second piece off as well. And especially when the market is iffy as it is now, and I'll use the S&P as guidance for that when I see it at resistance, because a lot of stocks follow the benchmark typically. So sometimes that works in my favor, being quick on the trigger.
Yeah, so I just put a few of Jeff's recent trades on the screen just so you can see what he's talking about with like trailing stops. For example, he had a CRISPR. So again, not stocks you're always reading about like in the Wall Street Journal and on Yahoo Finance. CRISPR, he got in at 36.11, then he got out at 37.90 with the final sell at 40. EXAS, Exact Science, is another great one. Got in short at 48.75. covered first at 47.70, then the second at 40.36. So Jeff is a really effective like trailing stop plan. So he's generally looking to get like the big meat of a move by not just rushing to get out every single time.
Yeah,
So
go ahead.
I'm sorry. Go ahead, Jeff.
Yeah, I was just going to say, taking half of the, whether it's a long or a short, taking half of the trade off profitably as it goes in your favor um, does a lot to build emotional capital. It's not just, it's not just taking a bite of a gain, but it has to do. There's nothing worse than having a trade go in your favor and then see it, evaporate and actually lose money on it. So this just fits my style and it works emotionally for me.
Okay, so what do you think makes you different from There's a lot of newsletter, there's lots of advisory services out there. Like, what really makes you different in terms of helping people make money?
Well, I think, like in anything, if you have a passion for what you do, and I love the markets, I'm not a casual trader, as I said. Um, if you love what you do, you have a passion, um, the chances are that you're going to excel at it, and that can bring something for the table for somebody else. I live in Malibu, and I've been here 20 years, and I used to be a surfer until I hurt my back. And charting and trading is a little like surfing. You don't have to know a lot about the physics of the tides and the fluid dynamics in order to catch a good wave. What you have to know, what you have to be able to do is to sense when it's happening and then have the drive to act at the right time. And if you have a passion, I mean, if for doing this, patience pays dividends. It sounds very trite, but when you're sitting there stalking a stock and it works out, and you just make money sitting at your turret doing it, um, it's a great feeling.
Okay, we just got somebody came in late, and I think this would be a good review for everybody. Um, so, how is the service delivered, and how often are you sending out alerts and context?
How often is the service delivered?
Yes.
Well, again, every morning. And I don't think I've taken, well, last Christmas I took a few days off, but I don't really think I've had a vacation in 4 years. So every morning, just to put it in context, every morning the daily market report is sent out, typically an hour to an hour and a half before the open. And again, that's my macro view, tells you what I'm looking at for the day, um, some learning lessons, charts, et cetera, et cetera. And the nightly report, which contains swing trades and day trades, both long and short, is sent out, um, typically within an hour to two after the close for the next day trade.
Okay, so this is a good question. Can we ask Jeff questions during the day?
Well, if
I'll take that one quickly. Yes, you can ask Jeff questions. We don't do any kind of personalized investment advice, but if you have a general question about the stock, the market, or a stock, like we can answer it through a mailbag. So Jeff, I would say that Jeff is very accessible. All you have to do is email us, and and if it's like something like, what do you think of gold? We'll send that an alert to everybody so everybody can learn together.
exactly.
Okay, do you trade any individual semiconductor stocks?
Do I? Absolutely. Um, Today we traded Microchip, MCHP, KLAC. Um, I have a position in Xilinx, XLNX short at the moment. Um, and we sent out an alert to go short CRUS before the in the last hour today.
Okay, so I'm a swing trader. About how many swing trades per month can I expect?
Wow. I don't know how many per month, but I would tell you that there's probably 2 or 3 a day between what's on the report, the nightly report, and any intraday swing alerts. So at any given time, we may have, other than the big picture swing alerts, but we have some big picture minor precious metal minor trades on at the moment. Apart from those, at any given time, there's probably anywhere between 5 to 10 swing positions, long and short.
Um, okay, do you do any intraday scalping?
Do I? Yes. Yes, and
Um,
basically, I was just going to say that that's the general purpose behind the day trade section of the nightly report, and the reason those stocks are listed as day trades, other than swing trades, because it looks like they have momentum either up or down that can continue, but it's unequivocal that they're going to continue, you know, for days or a week. So it looks like they could spurt. Looks like they'd have short-term momentum that will follow through, but I'm not quite certain that it's sustainable. Whereas the swing trades look like they're more sustainable, so they're larger targets. There's more juice.
okay, so we are gonna shut down the Q&A. We have one more question. I'm gonna blast the link out to you guys one more time. Again, it's just $47.50. You're getting 30 days of the daily market report newsletter. So that's 4 to 5 trades a day, 2 reports a day, multiple alerts. The Hit and Run 2.0 course, which is worth $195. The course is about 2.5 hours, contains 20 actionable strategies. That's 10 buy strategies, 10 sell strategies for gaps, breakouts, extensions, reversals. So it's pretty much everything you need. And again, just $47.50 for both. That's a $290 value. You can cancel anytime with no hassles. It'll renew it $95 a month. If you don't want to continue, just cancel. It's no big deal. I'm going to send you guys the link one more time. So please click it and check it out. Okay, and Jeff, the final question is, do you use any scanning software to pick out your stocks? So I guess how do you pick out the stocks that are on like your watch list?
Same way I've been doing it for years. I eyeball them. Just like I don't use indicators, I don't use any software really to scan anything. I've got a monitor with maybe 60 stocks on it, and those change. And within that universe, I've got a core group of probably my hit list, my watch list of probably 10 stocks up and 10 stocks down. So, and then every night, and then for the weekend report, I'll go and look at percentage gainers, stocks making new 52-week highs, and stocks making new 52-week lows.
Okay, that is going to close us out. Jeff, thank you very much for your time. We always appreciate it. And to the audience, thank you all for joining us. We realize we've gone over time a little bit, but we definitely appreciate your time. Jeff, thanks again.
Thanks, Mike. Appreciate it.